Okay, hey, Ryan here with Bond Street Mortgage. I have James on for our weekly mortgage update. James, I'll let you get started with the rates. What's going on with rates?
Rates are definitely on the lower end of the annual range. Looking at jobs number today was a bit on the disappointing side. So we are really at a crossroads. You're around that 4% 30-year fixed, if not a touch under, depending on the amount of time that you need today. But it does look like we're breaking through some resistance levels this afternoon. So there hasn't been any updates so far, but I do see that a possibility of rates going lower at this point based on a disappointing jobs number today. And not only today, they revised the previous month's number. So the net total gains for the year were actually much lower than expected. Unemployment rate is lower, but that was a result of more people, unfortunately, dropping out of the looking for work. So was not really a good number. And the economic numbers, again, we talked about it last week, have been up and down, and it's been very much the same as it's been since the financial crisis, 8 years plus of the same dynamics happening. And until we see more certainty on the regulatory front, possibly tax reform, as a business owner and many business owners out there, you just don't say, well, I'm going to go and invest or put money to work based on listening to what Washington is saying about what might happen in the future. As we all know, it usually doesn't happen, especially to benefit us as taxpayers. So it really is show me, and then I'm going to jump in, and we just haven't had that. So good thing is interest rates are low. We know the market that we're dealing with. I think it's been very consistent. There is still, word is that there's still a lack of inventory. There is plenty of buyers. I think for the first time in a long time, like we've spoken about, it is absolutely a seller's market out there today, especially in the more desirable areas. And we just continue to plug along at the same pace and the same rates kind of that we've seen over the last 8 years, right? So lows in the mid threes on the 30-year. We went as high as 4.5 30 days after the election, and we're at that crossing point, and it finally looks like it may drop down further based on the numbers and the economy today.
So the money's still cheap for anybody who wants to borrow. It's historically never going to get better than this, right? Probably.
Absolutely. The money is still very cheap. No question about it.
Can I ask a question about rate locks? Because I don't think we've ever talked about that here. Do you decide when a rate gets locked based on this news? Like, how do you figure that out?
It's a good question. And the reality is, a 0.25% in interest rate on a $400,000 loan may, make a difference of $50 to $75 a month. And that's significant. But, I always say, and our policy is, we offer free float downs. So if the rate market improves by at least 0.1% for you, we're going to float you down to that rate regardless. So for me, it's about interest rate protection, because this number today could have been very good and we'd be having the opposite discussion. And the people that chose to, kind of wait it out, would have been sorry for that. So I always advise we look at the closing date. If I see, and this is, again, 20 years of experience. Obviously, we have, mortgage advisors that are younger. And I say, if the client's out of attorney review, we have an offer accepted, they're favorable to our terms and the deal in front of them, and we're locking in the rate for them. You go ahead and lock the rate, and we see what the market does. If we can do better for them prior to closing, we will do that. There's no charge for it, and we're going to get them the better interest rate. I'd much rather have the conversation with you that, hey, rates dropped enough that I can get you down at a better rate than, hey, jobs number was really good and now the rate is 0.25%, and because we didn't lock, I have to charge you a higher rate. So nobody knows. I don't care who you are. The smartest people in the world, you look at, Goldman Sachs, historically, and all the big Wall Street guys there, projections for interest rates have been wrong over the last 5 years. They've always been on the higher side to where we actually end up the year. And it's been more the same. So if you're happy with the terms, you're happy with the payment, and you're closing, I would say within 60 days, because the longer rate term period you take, it will result in a higher interest rate. But if you're closing within 60 days, you're happy with what you have on paper, go ahead and lock it in. If you work with us as the lender and rates do drop prior to closing, we will renegotiate that rate for you lower. It's no charge to us, and it's a benefit we provide to our clients.
Cool. Okay, so we will renegotiate. So bottom line is, just trust James and his team. They're gonna try to get you the best rate possible.
It's like any other investment, right? And a mortgage is a very large investment. But you may want to buy Facebook stock, and when am I going to buy Facebook stock? And it's the same game, and it's a game that you don't want to play because we're usually wrong. I can speak from experience. I guessed right on Brexit last year, and I guessed right on the presidential election, and I made some bets in the market that things were going to go the other way because of it, and instead the markets went up. Even though I got even though I was right on those two events, I still lost some money because the market did opposite of what I thought it would do. So you never know where you're going to end up. And again, if you're comfortable and the terms are favorable and you're happy, go ahead and lock it in. And if things get better, we're going to take care of you there as well.
Cool, great. So let's move on to this interesting thing we've been talking about the last few days. A student loan mortgage refi. Is that the kind of way to put it?
Yeah, it's very interesting. So Fannie Mae has come out and said that if you have student loan debt and you would like to refinance that student loan debt into your mortgage, you can and still be treated as a rate and term refinance. So what that means is you can borrow the equity in your home to consolidate your mortgage and your high interest student loans and get a favorable interest rate as compared to a higher interest rate in normal situations of taking cash out mortgages on your home. So you still need 20%, up to 20% equity in the home for the cash out. But let's say you have 30% equity in your home, and you have a $300,000 or $400,000 mortgage, and you have $100,000 in student loan debt, and that's $500,000. And the property after those two numbers has the 20% equity left in it, or to make even numbers. Let's say between those two numbers you owe $480,000, and the home would be worth, and your home value is $600,000. We can give you the $480,000, consolidating the mortgage and the student loans, and give you the rate and term interest rate. And in many cases, that interest rate, because when you're taking cash out, the interest rate is higher, you're going to save about 0.5% in the interest rate.
Great. So the rate should be lower than what you get with a normal
cash
consolidation. Yeah, than with a cash out, or with a like if you went to consolidate your student loans in general.
Oh, absolutely. I mean, we just did one for a client where they're actually going to be in a 25-year at 4% for 25 years fixed, consolidating their first mortgage and their student loan debt. And they had actually about 28 and a half years left on their current mortgage. So we actually, if you took their mortgage payment plus their student loan debt on a monthly basis, we are able to put them into a 25-year mortgage, which means they reduce the term of the mortgage by 45 payments and consolidate the student loan debt. And that overall cash flow payment was lower than they're paying now. So it's a huge savings. I believe in that scenario, it came out to be $140,000 in savings over 25 years.
Are student loans usually like a 10-year term, and then what you're doing is you're kind of wrapping it into a 30, so you're spreading out and getting a lower?
So what happens with student loans, typically, actually, it's a function of what your income is, right? So whoever is servicing your student loans, you submit to them on an annual basis what your current salary, what your current income is, and then off of that, they're going to tell you what your payments are. So the term may vary based on those payments. I've seen some as high as 25-year repayment in student loans. So It's a function of what your income is as far as repayment goes, more than what the terms of the student loan are.
So I can imagine doctors, lawyers, people who have high student loan debt, they probably got out of college, bought a house in the local market they're in, and a lot of them probably haven't moved because a doctor's going to have his practice local.
Right.
So a lot of those people might find that they're 10 years into their mortgage right now and can wipe out some of those student loans, or at least get the payment down.
I don't know of anyone paying student loans right now that's paying an interest rate less than 6 to 7%, in my experience. I guess they're out there, but in having discussions with clients about it, typically, the interest rate is much higher than the current mortgage rate is.
All right, so if you own a home and you have student loans, you should look into this, right?
Definitely.
So for any real estate agents listening, if you have any clients, think about the deals you've done over the past year or two. Anybody listening, forward this recording to them. Let them listen to this part in the video and get in touch with James about this. This is very, very interesting. It could save a lot of people a lot of money on a monthly basis. Yeah. In general. Okay, so other stuff, James, well, we can wrap it up here. Just wanted to mention on our agents page at bondstreetmortgage.com/agents, I did a recording this week about a webinar funnel. I've gotten positive feedback on this. Basically, I recorded a webinar, sort of like what you're watching right now, with an agent in South Jersey, and we're running a Facebook ad that gives away the webinar. This is a nice departure from the normal kind of sign up for my real estate website just to see properties. Instead, the agent's giving real expert commentary on his local market and sets the stage for him to have better conversions long term. So if you're an agent, go ahead over to bondstreetmortgage.com/agents and check that out if you would. Let us know what you think. And that's it. James, you have anything else?
No, thanks, Ryan. I appreciate it.
Okay, talk next week.
Talk to you soon. Thanks.